Morning, sir.
Yeah, good morning. Yeah, today we are welcome to another section of the class. So we'll be moving to a new topic today, which is value-added tasks. Value-added tasks, which is what a close to what the last topic we did, which is what the withholding task. So we'll be talking about a value-added tasks. So value-added tasks. So simply before the task, value-added. So when they say value added is an increase in the value of goods and services in the process of their production or delivery. So when you buy something, then you are now selling it again. So that means what? Selling it again, you have added value. Maybe you repackage it or you did something to it to make it different from the initial way. So that means what you have added some value to it. So that is what value added. So for adding those value, it is also expected that we are going to pay tax. So this value added tax now is a form of indirect tax. It's an indirect tax that is what collected at various stages of production, from production to distribution. It is collected at all the stages of getting a product to the final consumer, from the manufacturer to the final to the final consumer. So it will be value added tax will be leveled at the various stages. So and it is a consumption tax. Unlike the last one we did, which is the withholding tax. The withholding tax is what? Is a tax on income. But this one is what? It's a tax on what? Consumption. So when you are buying any item, so you are expected to what? To pay that what? The value added tax. So if you don't buy the item, you will not be what? You will not be asked to what? To pay what? Any value added tax. It is a consumption tax that is levied at what? Various stages of what? Of production from where? From manufacturer to what? From the manufacturer to what? To the final consumer. So as I said, it's an indirect form of tax that is borne by what? So and the burden of this VAT. So because this VAT, as I said, is paid at what? Various stages of production. So by the time that particular tax is charged at various stages, the final burden of the entire amount, of the whole amount, will now be what? Will now be shifted to what? To the final consumer. So it is the person that is going to consume the product, or that is what? Going to utilize the service that will feel what? The impact of what? Of this what? Value added tax. So it is a tax that is charged. So before now, it was charged at the rate of 5%, but the rate was increased to what is now at the rate of 7.5%, which is effective from February 1, 2020. So the value added tax rate applicable now is on 7.5%, which took effect from February 1, 2020. And it is only collected and administered by the Federal Inland Revenue Service. So by the Federal Board of Internal Revenue, Federal Board of Inland Revenue, which is collected through a Federal Inland Revenue Service. So basically, value added tax is a tax that is collected by what? By only the FRS. So after the FRS has collected it, will now be shared to the various arms of government. So it is not, the money does not belong only to the federal government. After the FRS have collected it on behalf of the government, so the federal government will now share it to the three arms of government by what? Federal government will take its own portion, state government will take and what? And also what? The local government. So there was a time that issue came up on it that some states they want to what? They want to start collecting what? Collecting this form of taxes. But that was what? That was nullified by what? By the law. So the law now what? Now specifically what? Make Federal Inland Revenue Service as well as the tax authority for administering and collecting value added tax. So the value-added tax is a form of tax that replaces what is called the sales tax. What at the initial stage, before the value-added tax was introduced in 1993, which took effect in 1994, we also have a tax that is usually charged on consumption. That tax is called what? Sales tax. So that one is not charged. It's just a single stage. It is charged as a single stage, unlike also. So the value-added tax is a tax that replaces what the old sales tax that is usually charged as at a single stage of distribution. So basically, the value-added tax is a multi-stage tax collected on sales at all stages of sales and distribution. From when the product is being moved from the manufacturer to the wholesaler, the value-added tax will be added by the manufacturer. From the wholesaler to the retailer, value-added tax will also be added by what? By the wholesaler to the retailer. Then from where? From the retailer to the final consumer, the retailer will also add what? Add a value-added tax. So the consumer is not selling the product, it's the one that is going to consume the product. So the final burden of all the taxes that are charged at those stages will now be borne, will be bear by the final consumer. So who is the one to consume the product. So the Value-Added Tax Act has specifically defined what is called goods and services, because this particular scenario usually bring issues. Before, there is usually problem between the tax authority and taxpayer. That some taxpayer will state that some items are not supposed to be vatable, why some items are supposed to be vatable. But the tax law has specifically defined what is going to be regarded as what? As goods, and what you are going to regard as services. So in the case of goods, goods mean all form of tangible property that are movable or immovable, but does not include land and building, money, or security. So goods now has now been defined to mean all forms of what? Tangible property. Anything that is tangible, that is visible, that we can see. So whether that thing we can move it or not. So the fact that we can see that it's not necessary that it has to be moved from one place to another. It does not necessarily has to be moved from. So that thing, once it is tangible. So it has to be what? It can either be what? Movable or immovable, but does not include what? Land and building. So that means what that is telling you that what? When you are paying rent now, rent that you are paying is no more what? Is no more vatable. It's not a vatable item. Land and building, money. So whenever you are also what? You are also exchanging your what? Exchanging money. So maybe you are exchanging your foreign currency to naira, or you are exchanging other money, or you are selling some other currency. So that is also not what? Not vatable. Or security. Also, whenever you are what? You are selling your security, maybe you are selling your shares, you are selling your bond, those are also what? Not vatable, because those are also good. So for it to say an item is a good must be something that is tangible. So that you can either move or you cannot move. Any tangible item that is movable or immovable are regarded as what? As goods. So while services means anything other than goods or services provided under a contract of employment. So anything other than goods or services provided under a contract of employment. Anything apart from goods, but that is what? That is carried out between what? Between two parties. That is a contract. That is, there is a contract between what? Between one party and another. That will be regarded as what? As a services. Or services can also be what? Any intangible or incorporeal property, product, asset, or property over which a person has ownership or right, or from which it derives benefits and which can be transferred from one person to another, excluding interest in land and building, money or security, any intangible or incorporeal property like goodwill, copyright, patent. All those what are also what regarded as what services. So when you enter into any of these, it is expected that what value added must be a value added tax, VAT must be what included before what? Before that particular item by the time what? So a value added tax must be included by what? By the seller before what? Before that item will be enjoyed by what? By the buyer. And which is usually what? Which is usually collected at the time of what? At the time of either what? Taking the what? The goods, or at the time of what? Entry into the agreement. So basically, value added is chargeable on both what? On both goods and services. Then so it is now stated that the following are to be noted. For this act, goods and services can be deemed to be supplied in Nigeria. So in respect of good, the goods shall be physically present in Nigeria at the time of supply, imported into Nigeria, assembled in Nigeria, or installed in Nigeria. For you to say a goods will be available for what? For a goods to be what? Charged value added tax. That goods must be what? Must be physically present in Nigeria. So for you to charge VAT on a goods, that goods must be what? Physically present in Nigeria. It must be a good that you have imported from outside the country, from another country into Nigeria. It must not be something that is still outside the country. Such item you cannot charge what? Value added tax on. Then the beneficial owner of the right in or over the good is a taxable person in Nigeria. So that also for you to charge value added tax on goods, that person you want to charge that value added tax must be what? Must be somebody that is liable to tax in Nigeria. For you to say somebody is going to pay value added tax here in Nigeria, that person must be what? Somebody that is what? That is liable to tax, must be a taxable person here in Nigeria. Who is what? Who is situated here in Nigeria or is taxable based on what? Based on the process of running business. Also, in respect of services, for a services to be what? Liable to VAT. The services rendered in Nigeria by a person physically present in Nigeria at the time of providing the service. That is for the service to be liable to VAT. That service must be rendered by somebody, must be rendered in Nigeria by a person that is what? Physically present in Nigeria. So that means what? If you are not present in Nigeria, so you are not what? Liable to pay value added tax. Then the service are provided to a person in Nigeria, regardless of whether the service are rendered within or outside Nigeria. You must be what? You must be present here in Nigeria. You must be what? In Nigeria before what? Value added tax will be charged on who? On you. So the fact that you are present in Nigeria does not mean that that person that want to charge the value added tax must also be what? Must also be in Nigeria. The agent can also be what? Can be outside Nigeria. But once you are in Nigeria, value added tax must be what? Must be charged on what? On the services, where the services is what? Is a service that is what? That is liable to value added tax. So this provision indicates that service performed in Nigeria to person in Nigeria is liable to VAT, which I have explained earlier, irrespective of the resident status of the service provider. So whether the person providing the service is in Nigeria or not, if that person is what? Physically present in Nigeria, that service will be liable to what? To value added tax. Services provided to person while in Nigeria, regardless of the medium of delivery of the service, is liable to VAT. So whether that service is provided through what? Through online process or digitally, so that does not mean that it's not going to be what? Available to what? To value added tax. Service rendered remotely, online, virtual means to Nigeria resident or person in Nigeria are liable to VAT in Nigeria. Where a third party is contracted to provide a service on behalf of a non-resident to his permanent establishment or feedback within Nigeria. such service attracts VAT, where a third party is contracted to provide a service on behalf of a non-resident to his permanent establishment. So there is another person that you have contacted that, okay, this is the person who is going to provide the service. So to somebody that is present in Nigeria. So to a what? To a company that is having what? A space base in Nigeria. So that service will also be what? Liable to what? To value added tax. So we also have what? For in the case of what? In the case of incorpora, or we also have in the case of what? Incorpora, incorporate, or intangible. So which are what? The exploitation of the right is made by a person in Nigeria. So that person who is making use of that right must be present in Nigeria. So in simple terms, basically, for a goods or services to be liable to VAT in Nigeria, that person who is going to enjoy that activity, or who is going to buy that goods, must be what? Must be present in Nigeria. Then for exported services, where you are now exporting a service will be regarded as exported under the following condition. The service must be provided by a Nigerian resident to a non-resident. So you are providing, so that person who you are providing the service is not a resident of Nigeria and is not what? Is not physically present in Nigeria. Such services will be regarded as what? Exported services. The non-resident person to whom the service provided must be outside Nigeria when the service is consumed. So for it to be what? To be regarded as what? Exported services. So that means what? You are not what? Physically present in Nigeria as at the time of what? Providing what? That services. So basically, VAT is liable on what? On both goods and services, on what? Taxable person that are what? That are present what? And available in Nigeria as at the time of what? Buying that goods, or as at the time of what? Providing that services, irrespective of what? Irrespective of what? Of the resident of the what? Of the service provider, or irrespective of the resident of what? Of the person providing the services. Then what are now the objective of value-added tax? So one of the objectives is to increase government revenue. So government, they need income, they need more money to what? To be able to what? To provide what? Basic amenity, and to what? To cater for what? For the economic objective. So as a result of that, so they use what? Value-added tax is one of the ways they make revenue to make the tax system more transparent, to let people know more about the tax system, to reduce tax evasion. So with that, you'll be able to work. So tax evasion is a process whereby people try to work to avoid, decide not to pay tax at all. So with value-added tax, government will be able to charge you what? Certain amount of what? Of tax. To increase export, because most of the exported services are not liable to VAT. To simplify tax collection procedure, to make what? Tax collection procedure to be easier. To check income tax evasion by consummate of actual income, which I explained earlier. To reduce the cost of administration by focusing its compliance monitoring efforts on large businesses only. So because it is mandated on anybody that is providing what? VATable goods to what? To charge VAT. So it reduces what? The work of government. So that means what? Administration of tax is what? Is reduced for what? For the government, because it is mandated on what? On every taxpayer, on every agent who deals in what? Taxable goods and services to what? To charge value-added tax. So what are the features of what? Of VAT? So I made mention earlier, it's a consumption tax. So it's a consumption tax, yes. Then it is a multi-stage tax system. It is usually charged at every stage of what? Of the distribution from the production to what? To distribution. That is from the manufacturer to what? To the final consumer. So then VAT was initially invoicing based. So whenever you issue an invoice, it's expected that you must charge VAT. But the Finance Act 2020 has now changed VAT to what? Cash based. Value added tax is now strictly on what? Cash basis now. It is only when what? When payment is made, that's what you are going to what? Be liable for what? For the value added. So when you have sold the item, that you are going to be liable for what? For the payment of what? Of the value added tax. It was initially charged at the flat rate of 5%. I made mention of that earlier. It is now what? 7.5% from February. So which was the new tax law is even looking at what? Looking at increase in what? In the value added tax. It has an inbuilt self-assessment credit mechanism. So it is not a system whereby what? It is self-assessment. That is what, once you deal in any vatable goods or services, it is mandated what that what you must charge what value added tax. It is what it has an inbuilt self-assessment credit mechanism. Then what are the principles of what value? The origin principle, origin, and the destination. Origin principle. Origin principle means that value added tax will be charged on goods are what are being produced or where the services are originating from, other than where they are being consumed. What origin principle means is that value added tax will be charged wherever that goods is coming from, irrespective of whether the goods will be or not. Value on that goods and services. So most of these advanced countries, most of these were developed country, China, and most of these developed countries, origin principle. So most of those items that are imported from this developed country, so value added tax has already been added on them because of they charge what? So they charge what is called what? Value added. They adopt what? Origin principle, in which whether you are consuming that item in their country or not, value added tax will be what? Will be charged on that what? On that goods and services. Then why destination principle implies that value added tax will only be charged on where the goods is being consumed. It is only where the goods is going to be consumed in your value added tax will be charged. That is what destination principle. Where the goods or services are not going to be consumed in your country, value added tax will not be what? Applicable to what? To that goods or services. So this is the type that is adopted here in Nigeria, destination principle. So that's why you see that most of the items that are being imported from abroad, so when those items get into Nigeria, they are going to what? Charge what? They are going to charge value added tax on them if they are what? Vatable goods and services. Because of anything you are importing to Nigeria, it is assumed that it's going to be consumed here in Nigeria, and we use what? Destination principle. So that implies that any item that you are exporting out of Nigeria, anything we are exporting, any exported goods or services, any item we are exporting to value in Nigeria, we adopt destination principle. So that is why value added tax is not charged on what? Items that are what? That are exported out of what? Out of the country. So any question?
Yes, I have a question, sir.
Okay.
My question goes like this, sir, because there are some transactions whereby I know, because I don't know, that's why I'm trying to ask this question. Because like the construction company I'm working now, there are some material like technology, we bought it in technology, whereby there's not going to be VAT. Why there are some, there's going to be VAT.
Okay.
And then also, I understand that VAT is 7.5, but
Yes.
like for instance, like the way it's coming from let's say that the supplier now 7.5 now, but I will still see a boss of mine whereby it's going to be removing 0.2%, 2%.
2%.
Yes, sir.
There is a difference between VAT and
Withholding
withholding
tax.
tax. Yes.
Oh,
Wherever you
oh,
see 2%, that is withholding tax.
oh, okay, sir.
Wherever you see 2%, that is withholding tax. All items that are vatable, whether goods or services, are
Yes, sir.
chargeable at 7.5%. Whenever you see any rate below that, that is withholding tax. Below that or above that.
Oh, okay, sir.
So that 2%
And
you are saying is not for VAT, because it is possible for you to have an item that will be both vatable and will also be liable to payment of withholding tax. You
okay,
can
sir.
have
And
wanted
then
to
also,
say
sir.
something again.
Yes, sir. And then also, sir, like for instance, now collecting a contract now, does like value added
Okay.
tax normally add to it or not, sir?
If the contract you are collecting, if the contract is a vatable item, if
Okay,
that
sir.
contract, we have items that are which we are still going to talk about. We have what is called vatable goods and services. If that item is a vatable item, that is item that you are expected to charge VAT on, that means they are going to charge value added tax on it. Then any income you are also receiving, they will also charge you withholding tax on it.
Okay, sir. Thank you much, sir.
Yeah.
Okay.
Any other question?
Yes, I do.
Okay.
For me, I think the goods under this VAT is not well understood by many people, or even some of us that consume them. Like now, I want to buy a TV set, and the person that want to sell the TV to me is trying to charge VAT. What value has he added to the TV?
Yes, now. Okay, you are looking at what value has he added to the TV for
Yes,
charging you VAT.
yes.
Yeah. Good, very good question. You know the TV you wanted to buy from him. You are not the one that went to the manufacturer yourself.
Yes.
He's the one who went to the manufacturer to get it from the manufacturer and bring it to closer to you.
Mm-hmm.
For bringing it closer to you, that means what? He has added value. He has done something, a work to you. Any work he do, it does not mean that it has to be what? That he do something on the product itself. But for doing any work to make it, either to make it easier for you or to make it convenient, value added. Closer to you, or making it easier for you to making it accessible to you. That is what value added. That is why you need to add the tax on it. It is not that it's going to put additional, not necessarily it has to do something again on the TV.
Okay. But
Yeah,
for
it's not
now, for us that we are being charged VAT and they take from almost everything we buy, can we use it to reduce our tax liability?
no. Okay. What is there is that, I made mention of something earlier. That's what the final burden is going to be borne by who? The final consumer. You cannot use it to reduce. If you are the one that is going to consume that item, you are going to bear the burden. Yeah, you are going to bear the final. What did you say? Government is 419, Abi? Government is 419. So they need that money. They need that money. They need the money to what? To provide for what? For the basic amenity. You can see your good road in your area, all the amenities they are giving you in your area. So they need those money to what? To provide all those facilities. So as a result of that, so if you are the final consumer, you cannot use it to reduce your tax liability. It is only withholding tax that you can use to reduce. But for VAT, no, unless the only time you can you can remove your input from your output if you are if you are not the final consumer, you are also selling it again. Because for selling it to another person, you are also expected to charge VAT. So, but if you are the final consumer, no way that you can use it to reduce your tax liability. Any other question? So let us now go. So there are some times that we'll be talking about under this value-added tax, so which we need to familiarize ourselves with. So we have a terminology in relation to VAT. So number one, VATable activity. VATable activity. So those, somebody asked a question earlier that, okay, is it everything that you buy that you are going to be charged value-added tax on? No. If that item is VATable, it will be liable to value-added tax. Like if you are collecting your salary now, it's not a VATable item. So there is not going to be value-added tax on it. It's only what? The normal tax, the personal income tax that will be charged on it. But other items, if you are engaging in some other activity, those will be what? Will be liable to value-added tax. So any transaction that is taxable, that is liable to VAT, is called a VATable activity. It can either be what? Transaction of the government. It can be transaction of company. It can be transaction of club. It can be transaction of association. So anything that is transaction that is taxable, that is liable to VAT, those transactions are called what? VATable activity. So, and this transaction is not necessarily mean that so it has to be carried out for the purpose of profit making. So even though if you are providing a service to somebody, where that service is not being provided for the purpose of profit making, but if that service is a service that is VATable, you are expected to charge value-added tax, irrespective of what, whether that transaction is carried out for the purpose of profit or for the purpose of what, for any other purpose, provided what it involves what, a consideration, provided somebody is paying to acquire that what, that goods or services. So even though if you are selling that goods or services at a loss, so it is expected that value-added tax must be charged if that item is a VATable transaction. So any transaction that is liable to value-added tax is called VATable activity. Then the second, we have a taxable or VATable person. Taxable or VATable person. So these are those agents who engage in what? VATable goods and services. Don't forget, we mentioned VATable activity earlier. So anybody, any agent or anybody who engage in what? VATable goods and services for a consideration, they call them a taxable or VATable person. So if you are a company now that is selling an item that is liable to VAT, you are what? A VATable person or a taxable person. So you are selling an item, so for a consideration, that's what you collect money from your customer to give that item to them. So you are regarded as a VATable person. And one of the obligations you have is what? You are expected to register for the purpose for VAT payment. As a VATable person, you have an obligation to register for VAT payment. And after registration, any VAT you collect on behalf of the government, you also have an obligation to remit it within what? On or before 21st day of the following month. So failure to do that, that amount will be liable to penalty and interest. So as a VATable or taxable person, you have an obligation to register. Once you deal in VATable activity, you must register for VAT. After registering, you must deduct the VAT. After deduction, you now remit any VAT you deducted within what stipulated time period, which is what? On or before 21 days of the following month, which must be what? Remitted. Then we have a VATable period. So VATable period is a period of what? 1 calendar month. It's a period of 1 month, commencing from the beginning of the month to the end of the month. What that means is that what all the VAT that you collected from January, if assuming you are now in 2025 now, all the VAT that a company collect from August 1 to the end of August, to August 31st, to August 31st. So they must what? They must record all of them together. They add all of them together as what? As a single VATable period. So VAT is payable on a monthly basis. So the period of remitting VAT is what? Is a month on a monthly basis. So beginning from the beginning of the month to the end of the month. So from 1st of August to 31st of August, you collect all the VAT collected for that period. You now what? Have up to what? 21st of what? September to remit that money to what? To FIRS. Failure to remit it as at 21st of September, that month, so that amount will be liable to penalty and interest. Then we also have what? Input VAT. So VAT, that is the VAT that you suffered on what? On purchases or on invoices issued to an agent. So by the time you purchase, because that item you want to sell, that item is not going to fall down from heaven. That item you want to sell, you too, you're also going to get it from somewhere. Or even though if you are the manufacturer, that item you want to manufacture, you are going to use some raw material or some other equipment to manufacture those items. So those things that you use in manufacture the thing you want to sell. So before you get those things, anybody that you also need to buy it. By the time you are buying it, the person you are buying it from is also going to charge you what? Value added tax. So any value added tax you suffer as a result of what? Purchases is called what? Input VAT. So value added tax suffered on purchases are input VAT. Then we also have what? Output VAT. So those are what? Value added tax collected through sales of what? Of the product of goods and services. So when you are now selling your goods and services, it is expected that you must also what? You must also charge VAT. So the value added tax that you charge from the sales of what? Of that product that you manufacture is called what? Output VAT. Then we have a VAT return. Before I go to this refund, we have VAT return. It is expected that what you collect, the difference between your input, that is what you suffered, and what you collect, the difference between them. Under VAT, the tax law gave you a right to remove your input VAT from your output VAT. That is to know how much you are going to pay to the relevant tax authority. You can look at the difference between what you collect and the difference between what you suffered, which is what? You remove your input VAT from your output VAT. So the difference is what you are now going to what? What you are now going to pay to FIRA, to the relevant tax authority as what? VAT return. So that means under value added tax, the tax law gave you a right to set off your input VAT from your output VAT. Unlike what we have under withholding tax. You know, under withholding tax, we said our withholding tax payable cannot be what? Set off from where? From the withholding tax claimable. So, but under the VAT, you can remove your input VAT from your output VAT to know how much is remaining to be what? To be remitted to the what? To the relevant tax authority at the end of what? At the end of the month. Also, it is possible that what I suffer will be more than what I collected in a month. That means I'm going to have what? A VAT refund. So VAT refund will be when your input is more than the output VAT. So when input is more than output VAT, we are going to have what is called VAT refund. So we can have a VAT refund or VAT payment or return. Refund is what? When input, what you suffer is more than what you collect. While payment is what? When what you collect, when output is more than your input. So that is what return. For a consideration in money or money's worth. So taxable supply. Also, it's also, so any transaction you are dealing with that involve what? That is going to be, that's going to involve a consideration in money terms or money worth. It's called what? Taxable supply. So that those are what? Supply that will be liable to what? To value added tax. Once that's what? That supply is involve what? Money or consideration in money. Then we have a VAT exclusive. So when they say an item is VAT exclusive, what that means is that what? The VAT element is not included in the amount given to you. We said, I made mention earlier that VAT rate is at the rate of 7.5%. So if you are now told that that information is VAT exclusive, that means the 7.5% is not part of the amount given to you. If, for instance, we are told that the invoice price is 100 naira, and the examiner now say VAT exclusive, that means the 7.5% of that 100 naira is not part of that amount. So if you are given a scenario like that, so how do we, to calculate the amount of the VAT, just apply the VAT rate on what? On the invoice price. That is, the VAT rate will simply be what? 7.5% of what? Of the invoice price, which will be what? 7.5 divided by 100, multiplied by what? The invoice price will give you what? The amount of the VAT, because what? It is what? VAT exclusive. Then when they say VAT inclusive, that means it include, is English. So what that means is that what? The VAT amount is included as part of what? As part of the invoice price. So the amount of the VAT is also part of what? Part of the invoice price. So that is what? VAT inclusive. If you have VAT inclusive, to calculate the amount of VAT will be what? 7.5 divided by 107.5 times multiplied by what? Invoice price. So for VAT inclusive, that would be what? 7.5 divided by 107.5. So divided by 107.5, multiply by what? Multiply by the invoice, price, because it is inclusive. That means what? Instead of the invoice price to be 100%, the invoice price is 100 plus the 7.5, which is where what? The 107.5 is what? Is arrived from. So in the exam, where the examiner now give you a question and the examiner is silent, the examiner did not tell you whether it is VAT inclusive or exclusive. So please, you have to assume VAT exclusive. So where the examiner did not mention whether it is inclusive or exclusive, you assume VAT exclusive. But where it will be inclusive, the examiner will what? We give that what? That information. It will be stated by what? By the examiner. Then we have what? The task point. So what are the task points? We can have a basic and actual task point. That is what? In which period do we start what? To recognize what? To recognize the VAT. So we have what? The basic task point for goods. The basic task point for supply of goods is the day the goods are removed. So whenever that goods are what? Are removed from the warehouse, it is expected as well. The value added tax on that goods must be what? Accounted for, which is what? The basic. So for services, it's the day the services are performed. So when the services are performed, so you are expected to recognize what? The value added tax. Then the actual task point, when are you now supposed to what? To recognize it actually? It's usually the invoice date, the date of the invoice. So whenever what? The invoice is being issued, where a VAT invoice is raised or payment is made before the basic task point, there is an earlier actual task period created, or whichever occur first. So it is possible that you have raised, before raising the invoice, you have entered into an agreement. You have told the supplier before. We said the basic task point for goods is when the goods is being removed or taken away. And for services, when the service is being performed, before you perform the service or before the buyer carry the goods from your warehouse, he has already made payment. It is expected that what the value added tax must be what must be recognized as at the date of what as at the date of that payment. That tells you what you have an actual tax point. So whenever payment is made, whether that goods has been removed from the warehouse or not, since payment has been made, the value added tax must also be accounted for. So that is what for the actual tax point. Then we have what in the case of continuous supply of services, if services are supplied on a continuous basis and payments are received regularly or from time to time, there is a tax point every time invoice is issued, payment is received, whichever happens first. So the supply is not once. So that means what your invoice will come and payment will be made at various intervals. It is also expected that value added tax must also be added at each of those interval that you are making you are making your sales or you are making the supply of your goods or services. So basically, so it is expected that whenever payment is made, you must recognize the value added tax. In summary, situation when do we recognize the value added tax? In situation no invoice needed. Where there is no invoice, it will be the date of supply, where you don't need to issue any invoice. The day that you are going to supply that item will be the day that the value added tax will be charged. Where that invoice is issued, then that will be the date of the invoice. It is expected that that value added tax must be recognized. Payment or invoice issued in advance of supply. So before you supply, as I said, where you have already made payment, before you remove the item or before it is being supplied, the service is rendered, the value added tax will have to be recognized as at the date of the payment. Date in advance of supply and no VAT invoice yet issued. The date payment is received. So whatever form, it is the date that the payment is being made that the value added tax will be recognized by according to the tax law. Then for you to be regarded as a taxable or vatable person, you must register as a vatable person to charge value added tax. You must have registered, whereby a VAT certificate will be issued to you by FRA for charging value added tax. So that means you and I, that we don't register, that we are individual, we cannot charge value added tax. So what are registration of taxable person? As an agent for VAT, it is expected that you must charge you must register for value added tax, and it is expected that you must register for value added tax upon commencement of business. So when you are commencing your business, it is expected that you should register for for the purpose of charging value added tax. So this registration is liable to anybody that is dealing with vatable activities. If you are dealing in any vatable activity, you are expected to register for value added tax, whereby a value added certificate will be issued to you. And when you are registering, because I mentioned earlier that the tax authority in charge of collection of value added tax is FRS, and we have FRS office across all the state of the federation and in various locations in some states. It is expected that when you are registering for the purpose of value added tax, you register with the nearest FRS office that is closer to your that is closer to your business. It is expected that you register with the nearest FRS office that is closer to your place of business, in order for them to be able to track your record and monitor your activities. So you must register with the nearest FRS office that is closer to your place of visiting. A resident of Nigeria who performs service outside Nigeria should also register with a local VAT office. If you are a VATable person, but you are a resident of Nigeria, but you are providing your services outside Nigeria, you are also expected to register with the FRS. So either the Federal Inland Revenue Service or the Federal Capital Territory, or the one that is convenient with you, you must also register. Because the reason why you need to register is if you may also need to deal with any individual that is are present in Nigeria. Also, a non-resident company that carry on business in Nigeria, according to Section 10 of shall register for VAT using the address of the person with whom it has substituting contract for the purpose of correspondence relating to VAT. Also, it is also expected that where you have a non-resident company that does not have, that non-resident, they don't have any office in Nigeria. The fact that they don't have office in Nigeria, they are also expected to register for the purpose of VAT in Nigeria. So because they don't have office in Nigeria, so they are going to use the address of what? The law said they should use the address of the person they are dealing with. That person they are dealing with in Nigeria, who is having a location in Nigeria. It is the address of that person that they are going to use as the address for the purpose of registration. So what that means is that for registration purpose, both resident company and non-resident are expected to register for the purpose of value-added tax. Then also every government ministry, statutory body, other agency of government shall register as agent of the board for VAT purpose. Every government ministry. The fact that an agency is an agent of government does not make them to be to become automatically agent for collection of VAT. They must also register for the purpose of collecting VAT according to the VAT rules and regulation. Also, it is also possible that you have a business that is having location in different states. So, like you have a company now. Let's say, for instance, we have Nigeria Bottling Company, which is the producer of Coca-Cola. You have Coca-Cola in Lagos. We have in other states in Nigeria. It is expected for the purpose of what? For the purpose of value-added tax. Each location must register with the nearest FRS office for the purpose of what? For the purpose of value-added tax. So that means Coca-Cola in Lagos will register with the nearest FRS office for VAT purpose. Coca-Cola in Oyo State will register with the nearest FRS for the purpose of what? Payment of VAT. But it is still the same company because when they are making payment, they are going to use the same TIN number. But the reason why they need to be closer, to register with the FRS office that is closer to them, is for the purpose of monitoring their activity and for the FRS to be able to track their record. You don't expect a company that is located in Nigeria now. You now expect what? They now have another, maybe their head office is in Abuja. So if you now say, okay, the one that is in Nigeria should also be making their payment and also be liaising with what? The Abuja FRS. So that is going to be what? Not convenient for what? For the taxpayer. And according to the tax, one of the characteristics of tax is that it should be convenient. So in order to provide that conveniency, they are expected to register for VAT with the nearest FRS office that is closer to their office for the purpose of what? Value-added tax payment. So that means if you have various locations, your location will also register with the nearest FRS office. FRS is the same, but you have to register so that they will be able to track your record and monitor your activity. Also, as you are expected to register, if you are also ceasing operation, you are also expected to deregister the registration for VAT. If you are ceasing operation, it is expected that you must also give the tax authority that information. So when you are ceasing operation, you must give them that information within 90 days afterward, after the date of cessation. Failure to do that, failure to tell them that your company has ceased operation after 90 days from the date of cessation is also an offense that is liable to penalty and interest. So if you are ceasing operation, you are also expected to deregister for the purpose of VAT. So the registration means that your name is supposed to be removed as part of the those that are expected to render value-added tax return. That is what the registration. And you have within 90 days after the date of cessation to give FRS such notice of the registration. So failure to do that is also an offense which is liable to certain penalty. So as I told us earlier, where a taxable person are carried out in branches or division or depot. So I explained this earlier. When you have various depots in various states, it's expected that you should register with the nearest FRS for the purpose of value-added tax. So as an agent that is registered for VAT, it is expected that you must keep record of the transaction of your activity. Failure to keep record of your transaction is an offense. So according to the Value-Added Tax Act, you must keep record of all your transactions relating to VAT and all your transactions, whether the transaction relate to VAT or not. It is expected that a business must keep record of their transaction. So when tax authority come for either their tax audit or tax receipt, if you are unable to provide the record, it's also an offense that is punishable. Then we have a tax invoice. Tax invoice. So this invoice is usually an invoice that shows that your VAT has been charged on a particular item, or VAT has been paid to the relevant tax authority. It's usually a form that is so it's issued in support of a transaction whenever vatable goods and services are supplied. So they call it a VAT invoice. It's a form that's going to be filled by the agent to show that a transaction has occurred that relate to VAT. So that when you want to render the VAT return, you are going to give information about the invoice. So what are the content of customer name, invoice number, like the warrant, value added, a description of goods and supply, rate of any is being offered, total value, gross amount of tax will be stated in the tax invoice, which should be issued. It should be issued on supply of taxable goods or services when payment is made at the time of supply. So this tax invoice now is to show that yes, somebody has deducted VAT from the transaction I entered with him, or I have paid I have paid VAT. So if I'm now selling that item again, which is going to serve as part of my my basis for claiming under the Finance Act 2020 threshold, which means that it is not expected to charge and collect VAT. Vatable person that trade in vatable activity. The fact that you are a vatable person If your annual transaction, your total taxable supply is what? 25 million naira and below. If you have an annual transaction of 25 million naira and below, it is expected that what? You are not expected to charge value-added tax. I want to see if that information. I don't think that. Okay. So, okay. I don't think that. Okay. Don't worry. I'm going to mention. So, by provision, only taxable supply with taxable supply of 25 million and above monthly return to FRA. Only those who deal in taxable supply of 25 expected to charge value-added tax. So what that means is that means small company cannot charge what? Cannot charge or collect value-added tax. So if a company is a small company now, so they cannot, because of the law has exempted them from charging value-added tax. Only those that reach what? Up to what? 25 million taxable supply per annum are expected and remit what? Value-added tax. Is now what? Is now the threshold. That is what? Tax law. So that is what? That is the limit. That is the limit that is being introduced by the tax law for any taxpayer before you can know whether you are going to charge value-added tax or not. Then anytime you get up to that 25 million, it is expected that you are going to charge value-added tax. The law now proceeds further. Determination of 25 million turnover threshold. The taxable person who has made taxable supply of 25 million prior to introduction of the VAT threshold. So what that means is that this law came in the Finance Act 2020 when the VAT was increased in 2020, February 2020 to 7.5. So from the commencement of the Finance Act now, if you are a taxable person who has made taxable supply of 25 million prior to the introduction of threshold, shall continue to charge, collect, and file a monthly return if it has not made 25 million taxable in the current year. What that means is that at the time they introduced this law, the law is saying that whereas at that time you are even yet to make what? To make up to 25 million as at that time of introducing this law, this threshold of 25 million. But where in the previous year you have already what? You have already made more than 25 million per annum, or you have made up to 25 million. You are expected to charge VAT. Whether or not, as at that time of introduction of this law, your transaction is up to 25 million. 25 million, that's before 1st February, shall immediately attaining what? The threshold. If you are yet before this date now, you are yet to get to that 25 million in previous year. But from that date, your threshold, you attain that 25 million, you are expected to start charging value-added tax. Where in the before this date, 1st February 2020, you are yet to, your transaction is not up to 25 million. As at 1st February 2020, by the time you also look at your transaction, you are also yet to be up to 25 million. You are not expected to charge value-added tax. A taxable person may voluntarily register, charge, or collect or remit tax and file monthly return to at any time without attaining the 25 million threshold. Such a person shall notify FRA prior to doing so and shall resort to provision of VAT and applicable to person. If you are of the opinion that okay, it is possible for you to attain that 25 million, but you don't want to wait up to that, you know that at the end of the year, your transaction will be more than that based on the invoices that you have. It is expected that you can voluntarily register for the purpose of VAT, even though without attaining that 25 million threshold. You can voluntarily register, but before you do that, you have to notify FRS of that information that you want to register for VAT for not attaining the threshold. Then you have a taxable person who has not attained 25 million, but expect to attain. So when you know that you are going to get to that 25 million, it is expected that you should also register for VAT and start collecting VAT. So a taxable person who makes taxable supply amounting to 25 million and above within a calendar year is required to file monthly tax return, even if part or the whole of such supply are exempt from VAT. Please note the definition of taxable supply. So taxable supply, if your total transaction throughout a year exceed 25 million, but part of those transactions, there are also items that are exempted. The fact that they are exempted does not mean that you are not going to charge VAT. So that means if they are exempted or zero rated, so that means those items will not be liable to VAT because they are exempted. If they are zero rated, that means the rate you are going to apply will be 0%. So what the law is saying here is that once you reach a taxable supply amounting to 25 million and above within a calendar is required to file monthly VAT return to FI, even if part of or the whole of such supply are exempt from VAT. You are expected to register for VAT, even though where all those your taxable supply are items that are exempted from VAT. You are also you are exempted to register. You must register. The fact that you are not going to charge does not restrict you from registration. You are expected to register and file nil return. So because all your taxable supply exceed 25 million naira. So those are the scenario to determine the threshold. Then a calendar year is a 12-month beginning from the beginning of the month to end of the month. The taxable person who attains taxable supply threshold shall continue to collect VAT and VAT return monthly. So what the law is saying there is that if I have attained 25 million now this year, so that has made me to be above the threshold. If in next year now, throughout next year, I'm yet to attain up to 25 million, that does not make me to say I'm not going to charge VAT. The fact that I have gotten up to 25 million in previous year, that has already made that particular agent to be a taxable person. So once you are a taxable person, you must continue to charge VAT. So from your transaction, whether in the next period you are up to 25 million or not. So to now determine this threshold, we have some scenario. We have illustration 1. Mr. ABC, a wholesale supplier of customer goods, commenced business in January 2019. By the end of January, the taxable supply amounted to 10 million. Furthermore, his taxable supply increased to 18 million in February and 26 million in March 2019. When will Mr. ABC be expected to register, collect tax, and file monthly VAT return? If you look at it, as of January 2019, his taxable supply amounted to only 10 million. That means he cannot register and charge VAT. As at February 2019, he increased to 18 million. He has not gotten up to the threshold. But as at March 2019, he now increased to 26 million. That means from March, he must He must start charging VAT and start remitting from where? From the next one, which is from April. So what the law is now saying that treatment is that Mr. ABC should approach FRS immediately attain the threshold of 25 million in March. Immediately from that March, when his threshold is 26 million, As at that month, whenever that period that he attained that 26 million, he must approach FRS and commence to charge and collect what? And remit what? Tax. And file monthly return to FRS by April. So for any transaction that he charged VAT on from that March, he must what? File what? The monthly return to FRS on or before what? 21st of what? April of what? Of that same year. So what that means that anytime you attain the threshold, you must start what? You must start charging what? The value added tax. We also have a second illustration where XYZ Enterprise, supplier of motor parts, commenced business in January 2019. And by the end of January, he has made taxable supply worth 12 million. Furthermore, in February, he got an order to supply another customer spare part worth 18 million. When will XYZ be expected to collect and file monthly VAT return? Whenever he attained what that you know that in January, his taxes is 12 million, is yet to get to the threshold. But as at February, he has already collected an order for 18 million. If you add this 18 million to 12 million, that will give us how much? 18 plus 12. That is 18 plus 12. 30 million, which is above the threshold. So what that means is that what? He must what? Start charging and what? Remitting what? VAT. From where? From February. He must start charging VAT from that February when he attained what? The threshold, and start remitting from where? From the next month, which is what? March of what? Of the following month. So the enterprise should approach FRA as soon as the contract was awarded. In this case, XYZ will surpass the taxable supply threshold of 25 million going forward. The enterprise should therefore issue tax invoice on contract sum of 18 million. So this 18 million will be VATable. Collect VAT, remit, and file beginning from the 21st of March 2019. So anytime you attain the threshold, you are expected to start charging and file monthly return according to the tax law. Any question? Then we also have what is called self-accounting provision. Self-accounting provision. There are certain type of organization or certain type of activity that you enter into, that those people you are entering into the transaction are not liable to either charge the VAT, or they cannot deduct the VAT due to their residency. As a result of that, you are expected to self-account for that particular VAT amount. That provision is what is called self-accounting provision. So this is usually adopted when you are dealing with either a non-resident, or when you are dealing with what? With a small company. If you are dealing with a non-resident that does not have any location in Nigeria, that non-resident does not have any location in Nigeria, it does not have any office in Nigeria, it does not have anywhere that the government can trace into in Nigeria, and you want to what? You want to deal with certain activity with him, and that activity is an activity that is liable to VAT. It is expected that you are in Nigeria, you must what? You must charge that value added tax yourself, and what? And remit it to what? To the relevant tax authority. So what the law is saying is that the supplier is a person exempt from charging VAT under the Act, as I said, where you are a small company that you are expected to charge VAT, or the supplier is a foreign company without a fixed base. You don't have a base in Nigeria. In that case, you are expected to self-account for the value added tax. How does this work? I want to deal in transaction with let's say XYZ UK. This XYZ UK, they don't have any office in Nigeria. They don't have any office in Nigeria. And I want to provide service. You have ABC Nigeria Limited. ABC Nigeria Limited want to provide service to SYZ UK. That company, SYZ UK, is located in United Kingdom, London. And ABC Nigeria Limited is a company that is located in Nigeria. So ABC now want to provide a service to SYZ Limited. And that service that ABC want to provide to SYZ, that service is liable to value-added tax. It's a service that is liable to value-added tax. Because SYZ, okay, or let me use, SYZ, let me use this illustration to make it easier. So SYZ want to provide service to ABC Nigeria Limited. Yes, let's do it that way. SYZ want to provide service to ABC Nigeria Limited. That means ABC is going to pay SYZ. And that service that SYZ want to provide to ABC is a service that is VATable. It's a VATable services. But SYZ Limited does not have any office in Nigeria, and they are not registered with what? With Nigeria, with FRS for the purpose of VAT. So it is now mandated on ABC Limited before making payment to SYZ to charge VAT on that item themselves. They must what? They must self-account for that, for the VAT on that item. They are going to charge VAT on that item themselves and also remit it to FRS themselves. So that means what? The responsibility of remittance is not going to be with what? With SYZ. Responsibility of remittance is going to be with what? ABC Nigeria Limited that is present here in Nigeria. What the tax law is looking at is if they leave the responsibility of remittance with what? SYZ, there is no way FRS is going to get that company because they are not resident here in Nigeria. They don't have any office here in Nigeria. So in order to make sure that that money is not going to what? Run away, and that money is not going to be with somebody that is not going to pay it. So that the responsibility of collecting and charging the value-added tax is now vested with what? ABC Nigeria Limited. So that provision is called what? Self-accounting provision. So when you are dealing with somebody that is either exempted from charging VAT or somebody that is not resident in Nigeria and does not have anywhere to pay the VAT to in Nigeria, you are expected to what? To self-account for what? For the value-added tax and remit it to FRS yourself. Then when you are remitting that amount to FRS, it is expected that you are going to remit it separately from your own normal remittance. There is going to be what? That one will be stated in a separate form from your own one, because you also have your own VAT, that is your own normal VAT. This self-accounting VAT will be what? Will be remitted separately, differently from your own one, from your own normal VAT. It's not going to be what? Combined together. So that is what they mean by what? The self-accounting provision. So you must what? Self-account for the value-added tax and remit to the relevant tax authority. So what are those items that are exempted from the value-added tax? We have exempted item. So under this exempted item, we have exempted goods and exempted services. So you are expected to know what this exempted item. So please, examiner may also give you this item as part of information that will be given to. Once you see any of them, they are what? Exempted. They are not liable to value-added tax. So you are not going to charge value-added tax on them. So goods, what are the goods that are exempted? We have a basic food item. Basic food item. So by going to a basic food item, you go to Booker. To Booker now to go and buy your food. So no value added. Or you go to open market to go and buy your food. Those are food stuff. So this is not when you now visit what? When you visit hotel or you visit what? Fast food. So that is no more what? Basic. So basic food item are what? They are what? Exempted goods. We also have what? All medical and pharmaceutical products, because government, they also want people to what? To live healthy. They want good health for people. All drugs and pharmaceutical products are also what? Exempted from value added in order to what? To reduce what? The cost. Then we have books and educational material. The government, they also wants you to be what? More educated and knowledgeable. So they are also, so that's what? To reduce the cost of what? Of those items. We have a baby product. Baby products are also exempted. We have oil export. Oil, wrongly written as all export. This item in some material, you will see all export. It is not all export. It is what? Oil export. When you export oil, it is what? Exempted from VAT. Because oil is what? Is a vatable item. And it is assumed that when you export oil, if you export it, that means it's not going to be consumed here in Nigeria again. And in Nigeria, we adopt to a destination principle. So that makes it to be what? Exempted from value added tax. Then we have newspaper and magazine, agricultural equipment and product, because government wants to produce more product, plant machinery, goods imported for use in export processing zone, plant machinery, purchase for utilization of gas, downstream petroleum, tractor and plow for agricultural, fertilizer locally produced, agricultural veterinary medicine, vegetable oil. So this came in Finance Act 2020. Motorcycle and their spare parts, right? So Okada, corporate bond and security, so government bond, life insurance, so any payment you are making for your, as in form of your life insurance is not going to be vatable. Locally manufactured sanitary towel, pad, and tamp. So manufactured sanitary pad, commercial aircraft engine, and commercial aircraft spare parts. Commercial and residential rent. I mean, when we talk about definition of goods earlier, we made mention of excluding land and building. So specifically, rent is no longer what? Is no longer a vatable item, whether it's for commercial or residential. They are what? Exempted from VAT. Before now, rent usually cause what? Disagreement between what? Between the relevant tax authority and what? And taxpayer, whereby tax authority will say they are supposed to charge VAT. So, but the tax law, Finance Act 2020 has specifically what? Exempted what? Rent, all form of rent from value added tax. We also have those goods that are exempted. Those services, sorry, we have medical services. So they are also exempted. Services rendered by microfinance bank and mortgage institution. So microfinance bank, mortgage, they are also exempted. Play and performance conducted by educational institution as part of learning. Also, all exported services, because once you export any service, it's not consumed in Nigeria. It's going no value added tax. Share passenger transport service, which is made available for public use, like the BRT. So the BRT bus is also not one. So the fee you pay for your BRT is not one. No value added tax charged on it. So this does not include what hired or rented vehicle. No. Then training and education are organized by not-for-profit making or public educational institution. When they train people, it's also, so any amount you are paying will not be liable to VAT. Interest on loan, interest for advances, interest for overdraft, and interest for savings is also not exempted. Interest for bank deposit, the airline transportation ticket issued and sold by commercial airline registered in Nigeria. Tuition paid for nursery, primary, and secondary education. So that came in Finance Act 2020. Because government, they also want you to be able to train your children. So hire, rental, or lease of tractor, plier, agricultural equipment for agricultural purpose, renewable energy. All these are services that are exempted from value added tax. The fact that we have goods and services that are exempted from value added tax, we also have some goods and services that are called zero rated. What they mean by zero rated is what? They are liable to VAT. This item, zero rated item, are items that are liable to VAT, but the applicable rate will be what? 0%. Zero rated goods and services are goods and services that are liable to VAT, but the rate that will be adopted will be what? 0%. So one of them is what? Non-oil exports. Under the when we did goods exempted, I made mention here that oil exports, it is not all, it is what? Oil export. So it is now here under zero rated now that you now have what? Non-oil export. That means if you want to export an item, it is possible for for a taxpayer to also export item that is vatable. Because that item is for the purpose of export. And if you are exporting it, that means that item is not going to be consumed in Nigeria. That makes it to be what? To be at what? So the rate you are going to apply will be what? 0%. Why? Because of Nigeria adopts what? Destination principle. And if you are exporting an item, that means you are taking it away from Nigeria. So that means it's not going to be consumed in Nigeria. So when you are exporting non-oil export, any form of export is at the rate of what? 0%. Then goods and services purchased by diplomats. So those who come to Nigeria to come and represent their country for the purpose of fostering trade and cordial relationship with Nigeria, any goods that they purchase, where those goods are liable to VAT, the applicable rate will be what? Will be 0%. Why? Because they are not liable to what? To payment of tax in Nigeria. They are liable to tax payment in what? In their home country of what? Of residence. Then goods purchased for what? Use in humanitarian donor-funded project. So this humanitarian donor-funded project are what? Goods provided by what? By non-governmental organization, religious, social club, not for government organization, which are not for what? For profit-making purpose, and which are for the interest of the public. A good example is what? During COVID-19, a lot of these foreign bodies, IMF, UN, they provided relief material to Nigeria. So some of those relief material that were provided, some of them are what? Vatable. So when they bring those relief material, you don't charge them any what? The rate of VAT that will be applicable will be what? 0%. Because what? They are provided to support your country. So they are provided for humanitarian donor-funded projects. So those are examples of goods that are provided for humanitarian donor-funded projects. So those are items that are zero rated. So any item apart from this are regarded as either exempted or liable to value-added tax. So what are now the difference between this exempted and zero rated? So we have exempted, the difference between exempted and zero rated. So the major difference between exempted and zero rated is that if an item is exempted, you cannot claim back your input VAT. If an item is exempted from VAT, any input VAT you suffered on that item, you cannot claim back the amount of input VAT. But where an item is zero rated, you have a right. So that means what? You did not pay the rate of when you are selling it, you are not going to charge any VAT. So what that means that any input VAT you suffered on that item, you have a right to claim back the input VAT. So that's just the major difference between zero rated and exempted. For exempted, any input VAT suffered on them will not be claimed back because those items is basically exempted. But for zero rated, so any input VAT you suffered on them will be claimed back in form of input tax. So then we also have problem of zero rated include registration. So registration, company whose products are zero rated are in tax system, so they must register for VAT. It is therefore more costly. On the other hand, companies whose products are exempted are outside the tax system. They do not have to register at all if they deal exclusive in exempt item. So zero rated, you must the fact that your item is zero rated, you must register. So to register is not what, so it is also costly for the purpose of registration. In order for you to be able to claim back your input VAT. So where your item are 0 rated, you are also expected, you must also file monthly return. You are expected to return. They must submit monthly return where your item is 0 rated. Then if your item is 0 rated, you're also subject to audit and verification. They must they have a right to come and audit your transaction to verify your account. Then also to claim back your input VAT. You know, I said any input VAT you suffer in form of 0 rated will be claimed back. To claim back the input VAT is not that easy. So which involve a lot of rigorous process. It also creates cash flow problem for taxpayer, because I have suffered input VAT by the time I buy that product. I now want to sell it for somebody. You said I should not charge, I should charge 0%. So that means that money I suffered, before I can get it from where? From the tax authority, it's going to tie up my money somewhere. It's going to create a cash flow problem for the taxpayer. So it's also another problem is fraud. Systems such as these are prone to fraud. So many paper fictitious companies have formed and used as front in perpetrating of fraud. So some taxpayer may see this as an avenue to be claiming input VAT from government by way of claiming a lot of input VAT as a result of the advantages that is available to 0 rated item. So basically, government prevent exemption to 0 rated due to the above reason. So because of exemption, you are not going to say you want to claim back any input VAT. So government prevent that items should be exempted and it should be 0 rated. Then we also have some items that are non-VATable activity. A good example is salaries and wages from employment. They are non-VATable activity. House rent, your rent, hobby activity, private transaction, commission on turnover, interest. So they are exempted. So they are non-VATable activity. So all these activities are non-VATable activity and so on and so forth. So those are the activities that are not liable to VAT as far as value-added tax is concerned. Any question? Any question? So any question?
Yes, sir.
Okay.
Good afternoon, sir.
Good afternoon.
Please, sir, can you still explain this self-accounting provision?
Okay, self-accounting is just English. You are going to you'll be the one to account for it yourself. For instance, you are dealing with, we said when we are doing that threshold, we made mention that any taxpayer, VATable person who does not get up to 25 million is not expected to charge VAT and remit. So you now as a taxpayer, you are a big company. Your own company is more than that 25 million. You now want to deal with that small company that is below 25 million threshold. And that item you want to transact with him is a VATable item. That means that company that you want to transact with by law cannot charge you VAT. And that item is a VATable item. So what the law says is that you that want to enter into that transaction, you are mandated by law to charge that the amount of the VAT, you charge it and remit it by yourself to the relevant tax authority. That is what self-accounting. You are going to be the one that will be liable, that will self-account for it. It's not the person that is selling to you that will account for that amount. You that you are paying will be, that when you want to, it is the seller that will account for the amount of the VAT that will be payable to the accounting. It is the that's going to be responsible for the payment of the value added tax. It is also applicable to when you are dealing with a non-resident company who does not have an office or a fees that non-resident is not liable to any tax in Nigeria. But that transaction you want, that the non-resident want to, is liable to what? To value-added tax. Don't forget, when we started, I told you that where any transaction in Nigeria, irrespective of where the person that is providing that transaction is resident, is that transaction will be liable to value-added tax in as much as in Nigeria. So if somebody now want to provide a service to you, you are in Nigeria, but that person that want to provide that service to you, that person is not have any office in Nigeria. He's just providing you that service because of you enter into an agreement with him to provide you that service online. So it is now mandated that before you pay him his own money, you are going to add value, note it, you are going to add value-added tax on the invoice price. So that means instead of paying him the money, the invoice price, and the value-added tax, you only pay him the invoice price. You are going to withhold the value-added tax. After you withhold it, you now remit it to the relevant tax. You remit it to FRS. That's what is called a self-accounting provision. You are going to be the one to account for it yourself. It either because the taxpayer is not liable to charge, or the taxpayer is not resident in Nigeria. Is it clear to you?
Thank you, sir. Thank you very much.
Yeah. Any other question?